Hello, today I am going to teach you how to analyze a company using DuPont three-factor analysis. DuPont three-factor analysis deals with return on equity. So the prerequisite to learn this DuPont three-factor analysis is to know about a few ratios. So let us know about first ratio, that is return on equity. Return on equity is nothing but net income divided by it's nothing but net income divided by, or I can say PAT divided by equity. So PAT is nothing but profit after tax. That is the abbreviation here used, which is nothing but profit after tax, which can be termed as net profit as well, net income as well. In a profit and loss statement, the bottom line is PAT. Next, so what we'll do is we are going to decompose return on equity into three different factors, and then we will see if return on equity is good, then why is it good? If it is bad, then why is it bad? So let's first divide return on equity into two parts. So I'll start with this. Return on equity is nothing but profit after tax upon equity. I can write the same thing as profit after tax upon assets multiplied by assets upon equity. I hope you agree. You can see the assets in the denominator and the assets in the numerator will get cancelled out, and we will get PAT upon equity as the previous one. So this is one factor, and I have decomposed it into two different factors. So moving on, here I can say that my PAT upon assets is nothing but return on assets. So you should know that return on assets is nothing but PAT divided by assets. It is very logical to see that return on equity is PAT divided by equity, and return on assets is PAT divided by assets. That means what is the profit generated by 1 rupee of equity is return on equity, and what is the profit generated if I create 1 rupee of asset, that is return on asset. Now the second ratio, that is assets upon equity, is basically known as financial leverage. This is a very important ratio to understand in finance industry. So financial leverage by its name it denotes that it is something related to leverage, that is something related to debt. If debt is high, then financial leverage is going to be high. All of us know that balance sheet equation is assets is equal to equity plus liabilities. Now, if liabilities increase, that means if debt is high, then liability is going to be high, and that is why assets as compared to equity will be higher. So assets upon equity, this ratio, this financial leverage is going to be higher if you take high debt. Taking high debt will increase your return on equity. Have you heard of this thing, that if there is high debt, then you are taking high risk? If there is high risk, then the expected return is also going to be high. So a high financial leverage can mean two things. First is that the company's management has very high faith on what they are doing, very high confidence of what they are doing is going to create value. That is why they are taking so much of risk. Has faith in their project. And the second thing could be that the company's management is taking a lot of risk. So if you believe in what you are investing, then if you take a lot of debt, if you take a lot of loan, lot of leverage, then your returns are going to increase. Let's take a small example. Say you bought a stock of 100 rupees. You bought it at margin. You invested 10 rupees and you got 90 from your broker. So this is your asset, that is your stock. This is your equity, that is what you invested. And this is the liability, that is what you got from the broker. Suppose at the end of the day, the stock becomes 110 rupees. If the stock becomes 110 rupees, you have to repay the broker 90 rupees, considering that you have taken the loan, that is, you have taken this 90 rupees to repay the 90 itself. So that's how this works. This is intraday trading. So intraday, you bought the stock at the start of the day, 100 rupees. You think that it is going to go up. You took a leverage of 90 rupees, that is, your broker provided you 90 rupees. So what's going to be the equity to balance this equation, asset is equal to equity plus liability? What should be the equity? I think you have guessed it, it's 20. So your return on asset here is just 10%, right? But your return is whooping 100%. See, that's the magic of leverage. That is the magic that we are talking about. If you have a lot of faith in this stock, then you should take leverage and then buy it. Okay? But see the risk. What happens if this stock goes to 90? If this stock goes to 90, you have to pay to the broker back 90 rupees. Then what's your equity? I think you have guessed it till now. Right? It is zero. To match the equation, asset equal to equity plus liability, your money went to zero. That means the asset is returning just minus 10% and your returns are minus 100%. Until and unless things are rosy, it is superb. So I'll make it green. Everything is green. Wow. But what happens if things go red? Right? If the asset is not creating value for you, then that is the risk involved in this leverage, in this debt. But if asset is creating value for you, that is so rosy. There is where, that is where you are multiplying your return on equity. So that is one ratio we have discussed about, which is financial leverage. Now let's further divide this return on equity. I have told you we have to divide it into three parts. So let's further divide it into, say I'll take this and I'll divide this one more time. Say I want PAT upon sales and then sales upon assets. You will understand why we are doing this. Now I decomposed return on equity into three parts. We have discussed the third part out of this, that is assets upon equity. And this is financial leverage, very interesting stuff. That is what we understood from here. It is very interesting. If things are rosy, then you are earning a lot. But if things are not good, then you can get bankrupt. So before going and taking on leverage, please keep this into consideration, right? If you just look at this and take on leverage, then you are not taking a calculated risk. So you have to understand the downside as well before you move on and do anything about this. So now we have discussed the third ratio, that is assets upon equity. What we'll do is we will discuss the first two ratios as well. Over here, I can say my PAT upon sales, that is my PAT upon revenue, is nothing but PAT margin or net profit margin. So this is my net profit margin. Let me write this over here and I'll name it here. That is my net profit margin. And my sales upon assets is nothing but asset turnover ratio. So let's quickly understand these two ratios in the context of a business. Let's take an example and understand it from there. So let's start with a DMart kind of business or a Walmart kind of business. So when I say a Walmart or DMart kind of business, they are a retail store who are selling things at a very low cost, at a very low margin. So their net profit margin is very low, while their sales upon asset, that is asset turnover ratio, is very high. So if I talk about DMart, so I'm saying DMart kind of business or Walmart kind of business, I'm saying these two ratios. So I can say that this is low while this is high. So what is driving the return on equity for these kind of business? Your answer should be asset turnover ratio. Asset turnover ratio is driving the return on equity for DMart or Walmart kind of business. But when I talk about some other kind of business like Audi or BMW, like luxury businesses, then you guys know that they are not selling a lot of cars. They don't want to sell a lot of cars, but their net profit margin is very high. Asset turnover ratio is not so high. Selling a lot increases your asset turnover ratio. Walmart sales is very high. It is the topmost company in the world according to their sales. But their net profit margin is not huge. It is 2%, 3% in that range. Talk about Audi in contrast. Its net profit margin is very high. It's from 25 to 30%. While their asset turnover ratio is not very high, it is, they sell around 3 to 4,000 cars in a year. So that's where you have to understand that what is driving the return on equity for the business. To analyze the business using this DuPont formula, this is three-factor DuPont. To analyze it using these three factors, we can say that we can derive that what exactly is driving the return on equity. Is it net profit margin? Is it asset turnover ratio? Or is it the company's management's decision to take on more and more debt? Now, if you want to compare two different companies, say Indigo, SpiceJet, say TCS, Infosys, say any two companies in the same industry, then you can pull out these data and then you can check that, okay, if TCS's return on equity is better than Infosys, then why is it so? Is it because net profit margin of TCS is high? Or is it because asset turnover ratio is better? Or maybe because the debt is higher? So you will get some answers to your questions. This is called a cross-section analysis where you are picking two different companies and you are comparing different ratios between them. But if I talk about only TCS and I say that TCS's return on equity is increasing year on year, then what you will do, you will pull 3 years of data for TCS and you will compare net profit margin for last 3 years. You will compare asset turnover ratio for last 3 years. You will compare financial leverage for last 3 years. Then you will say that return on equity is increasing because of, you will have the answer there. You will have many because of maybe net profit margin is increasing, maybe asset turnover ratio is increasing, or because they are taking more debt, that is financial leverage is increasing. From this way, you can do a time series analysis on the same company. Last thing, a company like Apple, world's biggest company according to valuation, net profit margin very high, asset turnover ratio is also very high. Both of these things are driving return on equity for Apple. Talking in layman's term, vada pav खरीदना है अगर, so I stay in Mumbai, so vada pav is the main street food over here. So you can think about your city's street food as well. Okay, so vada pav खरीदना है अगर मैं vada pav बेच रहा हूँ, if I am selling vada pav, then selling 2 or 3 vada pavs will not do it for me, right? So I need asset turnover ratio to be high. I know that vada pav mein the margin is so good. I'm selling it for 15 rupees and maybe the cost for making it is 7 or 8 rupees. Margin is good. But if I sell 2 or 3 or 10 vada pavs in a day, that will not do for me. This business is not doing good then. So I have to maintain a good balance between these two. I need a good net profit margin and I need a good asset turnover ratio as well. So while making the strategy, DMart thought about Okay, let me sell at a very low cost, at a very low price, but then I want to increase, I want that to be compensated using asset turnover ratio. And if my net profit margin is positive, maybe I can take a lot of leverage to multiply my return on equity, right? That is why this financial leverage is also termed as equity multiplier. Learn more about this, you will, understand a lot more things. This same decomposition can be done, into five factors. I can divide this into further into five factors, and then your an analysis will deepen into things, will go deep, and you will ask right questions to the right person, that why is this happening, why is TCS doing better. You will have the answer to it. You might have the answer like net profit margin is doing good. Okay, then if you want to ask further question about net profit margin, you can go even further and say, okay, what is the operating profit margin, right? So asking right questions will make you a very good financial analyst, right? So if you want to analyze and you want a starting point to analyze a company or to compare between two companies, then DuPont three factor analysis is a very good point to start with. Thank you guys.